Hello, and welcome to Becoming a Limited Partner, the Basics. In this video, my business partner Ian and I will break down in layman's terms what it means to be a limited partner in a large group investment, which we call a syndication. My name is Hilary Graves, and I am a multifamily apartment syndicator, meaning I participate on the active side of these investments. And part of my role is to qualify and vet the limited partners who participate on the passive side of the investment. I also help to manage the assets, and I currently have over 1,400 doors or apartment units under management in Pennsylvania, New York, South Carolina, Georgia, Oklahoma, and Florida. Ian, would you like to introduce yourself?
Absolutely. Thank you, Hilary. My name is Ian Schmidt, and I am in the Somerville, South Carolina area, and I partner with Hilary on multifamily apartment syndications in the Southeast, primarily in Charleston, South Carolina, and surrounding areas, as well as Savannah, Georgia. So we're a little over 600 doors under management, and been working with Hilary for, gosh, going on 3 years now. So thanks for bringing me on the call tonight, Hilary.
Absolutely. What is a limited partner? Basically, a limited partner is a person or an LLC that contributes down payment for a property in exchange for ownership shares in that property. And what we usually do is multifamily apartment buildings, but this can be done with all types of real estate investments. Mentioned earlier that there are two sides of it. There's the active side, which are the general partners, and the more passive side, which are the limited partners. And both sides of the investment come together, providing the down payment and also the money needed for capital expenditures such as a new roof or interior renovations, things like that. And in this way, the limited partner is completely passive. They're really just providing that, they're really just helping the deal get off the ground financially. And in exchange, they're receiving cash flow as the deal goes along and also profit at sale, which is usually kind of a bigger piece of the pie at the end, depending on their original investment. They do not make management decisions. One of the big perks is that you don't have to be part of the day-to-day management, but you can still reap the benefits of owning real estate. Every limited partner will be part of an investment LLC. And when it comes to tax time, you will receive a K-1. So the structure from a legal standpoint is pretty straightforward. What is the role of a limited partner? Choose the right team to invest with. Obviously, this is a huge part of it. You want to make sure you're choosing a team that has extensive experience in the market where the deal is being offered, and they have a proven track record of making good on their investment, executing their business plan, having done that successfully. If they've done that successfully 5 times, 10 times, 20 times in the past, there's a good chance that they can do it again because they are familiar with the process and the pitfalls and all the things to look for that could go wrong in investment. The experience is a big piece of it. You also want to choose a team where the values align with your personal and financial goals. Every team is different. Some of them have different ways of going about their deal offering, and you want to make sure that it's the type of team that aligns with you. Perform your own due diligence. This applies to the team and to the specific investment offering. You want to look at the market studies, look at the property condition report. If you know how to look at the underwriting, look at the underwriting or show it to someone who does know how to look at it and check out those financial projections. This is your time to ask questions and make sure you know everything that's going on with the investment offering before you jump in. We also encourage you to consult with professionals. Maybe you want to talk to your attorney or a financial advisor or an accountant to get a second set of eyes on the opportunity and to weigh in on whether joining an investment like this might be right for you. A lot of times those people know your financial situation pretty well. Sometimes they know it better than you do. The next step is then to indicate your investment amount in our secure portal and review the PPM. PPM stands for Private Placement Memorandum, And it's just a document that discloses all of the risks that are involved in the investment, any legal conflicts of interest that might be present, such as the seller is an old business partner or a family member or something like that. Those things are all okay, but we have to disclose that. So anything you would want to know about the deal is in there, and it's there for you to review so that you can fully understand what's being offered.
So one of the things that you really want to consider is you want to make sure you're not investing your very last $50,000 in your bank and depleting your bank account down to zero. So really you want to take into consideration the fact that these are long-term investments, meaning what you're comfortable with tying up for the foreseeable future. And your general partner or sponsor can go into all these details, but you want to make sure you're not, say, depleting your checking account to invest your very last pennies into one of these deals. Typically, what you're going to see is a range between $50,000 to $100,000, and most sponsors and very often many deals will be able to take IRA or 401k conversions. So if it's money that is not showing a return in your current investment vehicle and you prefer real estate, so many of these sponsors are going to be able to accommodate those as well. And then lastly, you really want to make sure that you're going in eyes wide open and you understand the risks of investing in real estate in general. If you were to take that same 50,000 and say purchase a single family home, you would be familiar with the risks involved there. So you would really want to do the same investing in a multifamily real estate syndication. What are the pros and cons of investing in real estate syndication? Pretty typically, Hilary and I are really only going to bring a deal to the table if it passes our stress test. I think the last deal we were involved in last year, we went through, correct me if I'm wrong, Hilary, but it was something like 108 or 110 deals that we analyzed before we submitted a letter of intent to purchase.
That sounds about right.
Okay, so once we get through to that, we are not going to present anything to our limited partners that's going to return less than about 16, 17, 18%. And it's also important to note that we are investing as limited partners ourselves. So I don't know about you, Hilary, but I have yet to see a stock beat a 17% return in my portfolio. So we're typically going to want to bring higher returns. Mm-hmm. If you are aiming to, on average, see a 18, 19, 20% return, you're also doing that without any of the managerial headaches or, without dealing with tenants, termites, or toilets, as we like to say. So, your liability is very much limited through the LLC that we would set up. And so your risk is really only as big as your investment. One of the cons you could consider is you have no control over the day-to-day managerial decisions, which I don't know about you, Hilary, but to me, some of the best investments I've ever made have been the ones that I don't have control over the managerial decisions. So maybe we could bump that up into the pros, but generally speaking, because these investments are passive in nature and you're not having to deal with the day in, day out decisions, you don't have control over managerial decisions. The other thing is they are less liquid because you are tying up your investment over a period of time. So again, if you were to invest $50,000 and purchase a single family rental on your own, it would be maybe as liquid as quickly as you could sell it on the open market. So this is a little bit different in that your investment is going to stay tied up, and it's generally for a 3 to 7 year period.
Thanks, Ian. Yes, how to get started is really quite simple. Reach out to a general partnership team that you know and trust. So if you've been following someone on YouTube or you like their website and you've learned a little bit more about how they operate, reach out to them, get to know them, get to a place where you feel comfortable with the team, and then get on their list and you start to receive the offerings as they become available. We mentioned earlier we don't do a lot of deals. Actually, we underwrite a lot and then only get one or two or maybe up to four, something like that, a year, just because we have pretty high criteria. So when we do find one, we send it to the limited partners or the potential limited partners so they can review it. And if they like it, and if you like what you see, you can invest and you go into the portal, sign the documents, and get wiring instructions, and then complete the wire at your bank, and boom, you are a limited partner and a part owner in a piece of real estate. If you have any questions about anything that we mentioned here, feel free to reach out to one of us. But thanks for watching and happy investing. Take care.